In the fast-paced world of global finance, volatility is inevitable. But no single policy shift over the past decade has caused as much uncertainty, and as many tremors, across global markets as Donald Trump's trade war. His imposition of tariffs and shifting approach to international trade ignited a market frenzy with consequences felt from Wall Street to Beijing and everywhere in between. Today we're diving into the economic turmoil that followed Trump's tariff turmoil. Donald Trump's presidency was defined by bold claims, unexpected moves, and a brand of economic nationalism that shook the foundations of the global trading system. But it was his relentless push for tariffs on foreign goods, particularly from China, that set the stage for the most dramatic financial shifts of his tenure. The story begins in 2018 when Trump announced a sweeping series of tariffs targeting China. His goal was clear: reduce the trade deficit, protect American jobs, and force China to adopt fairer trade practices. What followed, however, was far more complicated, and far more costly, than anyone could have anticipated. We're going to bring back jobs, and we're going to take on China. These tariffs will protect American workers and businesses. Trump's logic was simple: impose tariffs on Chinese goods and pressure China to negotiate a better deal. The plan, however, sparked an intense backlash, not just from China but from markets worldwide. Initially, Trump's tariffs were seen as a tactical move, a negotiating tool to get China to the table. But as the tariffs expanded, first on steel and aluminum, then on electronics, consumer goods, and even agricultural products, the ripple effects spread across the globe. The world's two largest economies were now at war, and the markets were the battleground. At first, the markets hoped for a quick resolution. There were brief moments of optimism, particularly when Trump hinted at trade talks, but the reality of a prolonged trade war began to set in, and the stock market reaction was swift and severe. Global stock markets began to slide, with U.S. equities taking a major hit in late 2018. The uncertainty around tariffs and their long-term effects on supply chains, manufacturing, and consumer behavior sent shockwaves through investor confidence. At the core of this was a massive disruption in global supply chains. Companies were suddenly facing higher costs for raw materials, and American consumers were hit with rising prices on everyday goods. The tariffs were especially damaging to industries like automotive manufacturing, agriculture, and technology. American farmers found themselves on the front lines as China retaliated with its own tariffs on U.S. agricultural exports, causing billions of dollars in lost revenue. Meanwhile, tech giants like Apple and electronics manufacturers feared the increased costs of Chinese-made components. Tariffs are a tax on China, not on America. China will pay the price and will be the winners. But despite Trump's assurances, the costs were beginning to be felt far and wide. Trump's tariff policies didn't just affect the U.S. economy. They triggered a domino effect across the globe, creating economic distress for both developed and emerging markets. China, of course, felt the direct blow. Its exports to the U.S. were taxed, but it wasn't just China that suffered. The European Union, Mexico, and Canada, key trade partners to the U.S., were all swept into the chaos with retaliatory tariffs that further disrupted the international trading order. Companies began to scramble faced with higher tariffs on Chinese imports. Many sought alternatives. Some turned to other low-cost manufacturing hubs like Vietnam or India, while others brought production back to the U.S., raising costs across the board. We had to make tough choices. Do we absorb the rising costs of tariffs, or do we pass them on to the consumer? Either way, it's a hit to our bottom line. Tariffs didn't just hurt us, they hurt our customers and our supply chain. After a year of escalating tensions, 2020 brought a glimmer of hope. Trump and China signed a Phase 1 trade deal which included commitments from China to purchase more American goods and address intellectual property concerns. But while the deal temporarily eased tensions, it didn't undo the damage caused by the previous years of tariff wars. While the Phase 1 deal was an important step, it wasn't a complete resolution. The structural issues between the U.S. and China weren't fully addressed, and the tariffs remained in place, continuing to affect the broader economy. The damage had already been done, and the uncertainty about future trade policies lingered. As the global markets slowly recovered, the scars of Trump's tariff turmoil remained. The trade war had introduced an era of unpredictability, forcing investors to reevaluate how to factor in the risks of trade wars and tariffs into their strategies. Trump's tariffs weren't just about trade. They were about a shift in the global economic order. The world has never fully adjusted to this new reality. We're still seeing the aftershocks of those policies, whether it's in the form of higher prices, reshuffling of global supply chains, or rising political tensions. The global market plunge caused by Trump's tariffs left a legacy of uncertainty, one that will shape economic strategies for years to come. While trade wars may be paused, the tension between the world's two largest economies, and the volatility of international markets, remains. In the end, Donald Trump's tariff turmoil was more than just a chapter in the history of trade policy. It was a stark reminder of how quickly global markets can be upended by the unpredictable forces of politics as the world moves forward. One question remains: will we see a return to stability, or has the damage been done for good? Thank you for joining us as we unpack the complex legacy of Trump's tariffs and the global market plunge. Stay tuned for more insights on the world's financial future.